Today we'll talk about the difference between fixed cost and variable cost, economies of scale, contribution, as well as break-even point. So let's start off. Here's a factory, and in our factory we've got 3 machines. So 1, 2, 3. The white dots represent employees, so we've got 3 machines and 3 employees. We've got raw material that goes in, inputs, and the output is a finished product. In our case, it's a Lego piece. So if we come down now, scroll down to fixed cost, our fixed cost would be things that do not change when we increase or decrease output. So our factory cost, let's say, is £50 a year, machines are £40, employees £10. Altogether, £100 is a fixed cost for the factory. Our variable cost is 10 pence for the raw material. So if we make just one piece of Lego, then we only pay 10 pence. If we make more pieces, so 2, 3, then we'll pay 10 times the number of pieces that we produce. But if we make nothing at all whatsoever, we still have to pay the fixed cost, because we've already paid for the factory, we've already paid for the machines, and employees are going to want wages. They're not going to sit there for free, even if you're not making any products. So now let's work out when we begin to make a profit. So we've got number of products sold, revenue, income, so when we sell the product, how much money we make, variable cost, which is the raw material, fixed cost, which is your machine, factories and employees, and then total cost is variable cost plus fixed cost. And then profit we work out, so we take revenue and we deduct it from the total cost. Whatever's left over is a profit, or in this case a loss. The reason being is because the first example is assuming we have made no products at all. So if we make no products, we get no money from the customers. But it also means we've got no variable cost, but we do have fixed costs, as I said earlier. Now what happens when we make one product? So if we make one product, and let's assume the selling price is £1. So we sell it to the customer for £1 for that Lego piece. The variable cost is 10 pence, as we had discussed earlier. Yeah, can you see that? Variable cost over there? Yeah, 10 pence. So £1 we get from the customer, and it costs us 10 pence in raw material to make that one piece. The fixed cost is £100. So how do we work out total cost? Well, 10 pence plus £100 gives us £100 and 10 pence as our total cost. How do we work out profit? Revenue, so £1 minus £100 and 10 pence, our total cost. So we now make a loss of £99 and 10 pence. Now, very important to note here is that when we made no products, we made £100 loss. However, when we made one product, our losses have reduced. So instead of making £100 loss, we're now making £99 and 10 pence. Right, let's quickly move on. If we make 2 products, what happens? So if we make 2 products, we sell them for £2 because it's £1 per product. So £2 for 2 products. Our variable cost is 10 pence for 1 unit because we've made 2, so it'll be 20 pence. Fixed cost remains the same. Our factory is not going to charge us any more. We're using the same machines, we're using the same number of employees to manufacture 2 products. Our total cost would be 20 pence plus £100, which is £100 and 20 pence. How do we work out profit? £2, the money that we got from the customer, minus our total cost. It gives us £98 and 20 pence. Now let me repeat the point I said earlier. If we make no products, we make £100 loss. If we make one product, we're making less of a loss. If we make 2 products, now we're making even less of a loss. So as you can see, it's worth making more products because it's helping us reduce our loss, even though we're not making a profit yet. So you might think, well, what's the point of making 2 products? I might as well not make anything. True, but you've already paid for the factory, the machines, and employees, you cannot undo that cost. So even though when you make 2 products, you're selling them only for £2, yeah, they're not covering your full cost, but at least it's helping you reduce your losses. Right, let's go to another example. So this time we're making 200 Lego pieces. So 200 products we're making, and each one sells for £1. So the customers pay us £200. Our variable cost was how much? Do you remember? 10 pence up there. So 10 pence times by 200 units we're making. And that means our variable cost, so the raw material from the suppliers, is costing us £20. Fixed cost, as we've said over and over again, remains at £100. Reason being is because we're using the same factory, same machine, same number of employees. It is true that if we all of a sudden, let's say, start making 20,000 units, we are going to need a bigger factory. Yes, we'll need more machines and we'd need more employees. True. But if we only increase it by a small amount, then we don't need to buy a new factory every time. We don't need to buy a new machine every time. So hence, the fixed costs remain fixed. Total cost, 20 plus 100 is 120. So profit would be £200 we got from the customer minus 120. So look, we made a profit. Let me show you what's happening to the cost, give you a breakdown, a fine breakdown. So let's work out cost per unit. That's very important. So when we made 1 unit, the cost for making just that 1 unit was £100 and 10 pence. When we made 2 units, the cost per unit has halved, is £50 and 10 pence. So what we're basically doing is we're looking at the total cost and we're dividing it by the number of units produced. Now look, our total cost for 200 units is 120. So £20 in raw material and £100 in fixed costs. So factory, machines and employees. £120 and we made 200 units. Our cost has come down to 60 pence. So as we make more and more units, we go from making 1 unit to 2 units. Our cost per unit has halved. As we go from making 2 units to 200 units, we've gone from the piece of Lego costing us £50, 10 pence, to it only costing us 60 pence. This essentially is economies of scale, because as we make more and more units, our cost per unit comes down. As we make more and more products, the cost of making each product comes down. And now look, we'll finally make a profit, right? Because we sell 1 unit for £1 and it's costing us 60p to make. Yeah, so 1 unit is £1 and it's costing us 60 pence. So the 40 pence would now be our profit per product. Let's talk about contribution. What's contributing to what? So contribution, this is how we work it out. We look at revenue minus your variable cost. So the money we get from the customer minus the cost for the raw material. £1 minus 10 pence gives us 90 pence. When we made 2 products, we got £2 from the customer and it costs us 20p. So 10 pence plus 10 pence for 2 products, 20p. £2 minus 20p gives us £1.80. This is what we are contributing towards our fixed cost. So even though 90p is not enough to pay for our fixed cost, but it will help to pay a little bit off the factory, a little bit of the machines, some few pence to the employees. And in this case, we're making £1.80. Again, £1.80 isn't going to cover our fixed cost because this £100 is too high, but at least it will pay some of it. So all contribution means is that when we take revenue away from variable cost, how much money is left over to pay towards your fixed cost. That's all it means. When we make 200 products, so we get £200 from the customer, minus a total variable cost is £20. We are left with £180. £180 will now go towards paying for a fixed cost, and it will easily pay. So if we pay off £100, we'd have £80 left, and that £80 would be our profit. And that's essentially it. In accounting, so those of you who are doing accounting modules, this could also be seen as gross profit. How? Let me show you. So this is your income. So if you look at income statement or profit and loss statement, this is your income or profit. No, not profit. It's revenue from the customer minus your cost of goods sold. So COGS, that second line on your income statement, that's it. That's your COGS, variable cost. So income minus your cost of goods sold is your gross profit. And that's essentially it, contribution. And this gross profit will then help pay off your expenses. What are the expenses? The expenses are your factory, your machines, your employees, utility bills. And then once you've paid off the whole lot, then what you have left would be your net profit. But let's not go into that because we're not here to cover accountancy, but I'm just showing you of looking at the same thing, but from an accountancy angle. Let's talk about break-even point. Break-even point is basically where you are making enough products to cover all your cost. You're not making any loss, but you're not making any profit either. So here's a formula. Contribution we've already done. Break even, this is how you work out. Fixed cost, which in our case is £100, divided by contribution per unit. Contribution per unit is 90 pence. How do we know that? We work out contribution per unit by looking at selling price per unit minus variable cost. Selling price is £1, £1 minus 10 pence. Our variable cost gives us 90p. 90p we put here, 0.9 representing 90 pence, and then £100 is a fixed cost. The answer is 111. What's 111? 111 is the amount of products that we need to produce to break even. So let's now test to make sure that is correct indeed. So if we were to make 111 units, we would get £111 from the customer because each unit sells for £1. Our variable cost would be 11 because it's 10 pence to make one unit. So 10 pence times by 111 units gives us £11. Fixed cost remains the same at £100, and our total cost would be £11 plus £100, which means it's £111. So how do we work out profit? Well, like we have with the above. So revenue minus your total cost. Our revenue is £111 minus our cost, which is also £111. So it's 0, which means we've not made any profit, but we've not made a loss either. Break even. Let me repeat again. Basically, you are producing enough units to cover all your costs, which is cover all your factory costs, all your machines. You've paid off your employees. Everybody's happy. You've also paid off your supplier for the variable cost. Everybody has been paid. Nobody is pending any payments. So everybody's happy. You also have not made any loss. You've covered all your cost, which means if I make even one more unit after this, I'll make a profit. So if I make 112 units, that 112th unit would be my profit, which I'll take home because I would have covered off all the variable cost, all the fixed cost. And look, it's evident that this is true because when we make 200 units, we make £200 revenue and our total cost is £120. 200 minus total cost, 120 gives us £80 of profit. So it's true we make a profit when we make more units. That is break even.